There we go. So when it comes to questions, I'll just be putting out a few true and false questions, and then we'll be going from there. So a big one is, when it comes to credit cards, paying your credit card bill just a couple days after the due date will not affect your credit report. Is that true or false? If you thought it was false, you would be correct. So any payment that's even after that due date is going to affect your credit score. And so it's important when you're taking out a short-term loan, like a credit card is, you're always paying it back by the deadline, and making at least the minimum payment so that your credit report doesn't get hurt. Second question. So last month, your credit card balance was 0. This month, your statement shows that you made a $500 purchase. If you pay off $400 by the due date, you will be charged interest only on the $100 that you have left to pay that's on your card. Is that true or false? And if you thought it was false, you would be right. So this is a really big one that gets a lot of people, is that if you don't pay off your entire balance by the due date, you get charged interest on the entire amount that you spent that month. So even if you pay everything up and you only have $10 left, you're getting charged interest on, say, $1,000 that you spent that month. So it can add up fast. The third question: if you use your credit card to take money out as a cash advance, you don't have to pay interest on the amount that you've withdrawn, as long as you pay your credit card bill in full by the due date on your statement. And so for those of you who don't know what a cash advance is, basically if you put your credit card into an ATM and withdraw money, that's a cash advance. And that is also false. So you do get charged interest on the amount, even when you pay it all back. So cash advances are even more pricey. And finally, without a credit card history, your bank may charge you higher interest rates on personal loans for cars, houses, or other things. Is that true or false? And that one is true. So a good credit history helps you a lot down the line when it comes to buying a car, buying a house, getting the best rates. And we'll talk about that later. But it's really important to develop a really good credit history and a credit score in your early years, so that when you need it, it's there for you. So when it comes to credit cards, as they are the most common tools, most of you can have or should have them. I would certainly recommend them for some people. They offer a lot of good conveniences, which we'll go over, but they also have risks that you need to be aware of. So you want to consider what your needs are and how you'll be using the card. We use different credit cards for different things. Reviewing the interest rate, the annual fees, the service fees, and other fees. There are a lot of different fees when it comes to credit cards that you want to be aware of. And then what benefits are being offered. So lots of credit cards offer different benefits, from travel benefits to simply benefits if you're shopping at Superstore, for example. Or it would be, I'm trying to think of the Aurelia equivalent. Loblaws is also another one. They have their own credit card, which gives you points when you shop, which can be nice, though it, of course, is designed to make you spend more. But another common one is how many people rent cars to go grocery shopping from Enterprise or Alamo or something like that. And you know how they always offer you the travel or the car insurance? Check your credit card, because a lot of credit cards do cover that. They will have third-party liability insurance as a service that you pay as part of the credit card. So if you use the credit card to make that car payment, that's a way that you can get a benefit from a certain credit card. Not every credit card has it, so definitely check. But just things to keep in mind. Lots of times the credit cards, the services you're paying for, can actually be used. And so, for example, a student credit card may not be the best option for all students. And this is kind of what I was getting at when it comes to the card for car rentals, is that typically that's a different card than your standard student credit card, which might just give you a cashback potentially. And so you'll want to take a look and see what card makes sense for your situation specifically. But it is important when you're using credit cards to keep control. And so it is always advisable to pay your balance in full each month. And if you can't pay it in full, you want to pay as much as you can to limit the amount of interest that you are being charged. But remember, you're always being charged on that full month, even if you don't pay the balance completely in full. You don't want to, or don't make only the minimum payment if you can. So the minimum payment is there basically as like, at the very least, pay this so it doesn't affect your credit score. But that minimum payment is not going to get you out of that debt anytime soon. And credit card interest rates are quite high at around 20%, depending on the card you have. And if you always carry a balance, then you want to get a low rate card. So there are cards you can get that drop that rate down to like 14%, which is better than carrying a 22% card. And so it's all about managing your situation. But always the ideal is to pay everything back in full each month. You can transfer the balance to a line of credit with a lower interest rate, which we'll get into that later. And you can pay a few days before the due date just to make sure you're not missing the payment, which is always advisable. Or if you're one of those people like me who like just hates remembering the due dates for bills, you can set something up with your bank where it automatically transfers the balance you owe on your credit card when it's due. So you don't have to think about trying to make a payment on time. It just happens automatically. So here we get into the minimum and fixed payments. So if you can't pay off your credit card charges each month, the best thing is to pay a fixed amount. And so this is just a way of budgeting how you pay credit cards to lower the interest rate or the interest amount that you're paying. And so, for example, if you have a minimum payment of 2.5% a month, and say, for example, in this, it's $75, the time to pay off your balance, if you make the minimum payment every month and you don't add on more money, and you don't make any more purchases, the minimum time to pay that balance off would be 263 months. It would be a long time. And over that time, you would be charged $4,115.41 worth of interest. It's a lot. Compared to if you decided that I can't pay everything off right now, but I do want to get out of debt quicker, just setting yourself a goal of a fixed payment each month, say $100, you're making above the minimum payment, but it's not fluctuating. You're not doing the 2.5%. You're just doing a fixed payment. It would drop it down to 41 months. And so you'd only be paying just over $1,000 in interest, which is massive. And then in this example, we're talking about an interest rate of 18%. Typically, every credit card I've looked at is around 22%, though there are lower ones, of course, and something you would have to shop around for. All right. So that's like the rundown of credit cards a little bit. Now, I know one thing, and we'll get into this when we talk about a credit score, but how many people have heard the myth of making some payments to your credit card is going to increase your credit score? So paying a little bit of interest. Probably quite a few of you. I looked it up. It's not true. It's something that is not expected. You don't need to make interest payments to increase your credit score using a credit card. You just need to pay it off on time. And there's a few other things that we'll get into. But let's talk about the other type of loans, the other type of debt that you would take on potentially now or later on in life. So student loans, I'm sure this is something we can all relate to, being students at Lakehead. We all have them, or most of us do, I should say. Mortgages, if you ever plan to own a house or a condo or some sort of property, you would have a mortgage. Car loans, if you ever bought a car with a line of credit. And then lines of credit, such as student lines of credit. And then there's other types of lines of credit as well that you can use for certain situations and set up with your bank or credit union. Personal loans, overdraft protection. So you may see something like that if you have a bank account and it has some sort of overdraft limit. And basically, if your bank account runs to zero, the bank will still allow you to take money out of the bank account and it will just become negative through an overdraft. And then they charge you high fees when you're doing that. But that's what overdraft protection is. And so credit scores. And so this is going to be the biggest thing to keep in mind over the rest of your life, is that your credit score matters. It's a really important number that is going to impact a lot of opportunities later on in life when it comes to borrowing money. Basically, it's an idea of what your credit worthiness is in a specific point of time. And so banks will use this to determine whether to loan you certain interest rates. If you have a bad credit score, they'll loan you at a higher interest rate compared to a good credit score. It will be a lower one. If you've ever gone looking for an apartment and they ask for your social insurance number, what do you think they're doing? They're running a credit report on you to figure out if they're going to allow you to lease from them or not. And so it's going to impact a lot of opportunities. And so it's important to know what is your credit score and what can you do to make it better so that you don't get declined when you're trying to buy a car, rent an apartment, or buy a house. And so the credit score will indicate your risk to lenders compared to other consumers. And the scoring system in Canada is between 300 and 900. The higher the score, the lower the risk. So you want it as high as possible. Typically 600 is a good score. Anywhere between 700 to 800 is really good. And anything below 600 is not great. You would want to increase that to at least 600. So lenders use credit scores to decide whether to lend to you and set your interest rate, as I had discussed. And so credit reporting agencies often charge a fee to give you your credit score, but there is a way to get it for free in Canada. And so I'll go over that. So how do you know what your credit score is? So there's two credit reporting agencies within Canada, Equifax Canada and TransUnion Canada. You may have seen their logos before. Ordering your own credit report has no effect on your credit score. And Equifax Canada offers a credit report. They call it a credit file disclosure. TransUnion calls it a consumer disclosure. So just be aware that they have different names for them, and they are services that people pay for. So when you're trying to actually order it for free, it's going to seem very hard because they don't want you to order it for free. They want you to pay for it. But you can't do that. There's information on the Financial Consumer Agency of Canada's website about how to exactly order it. I've included it a little bit here as well, so you know. You can order it by mail or fax. There's forms that you can download from Equifax and TransUnion. There's links to those forms on the Consumer of Canada website. You need to provide acceptable documentation, of course, and then it must be received by mail. And you can also order it by telephone. You can call the bureau and follow the instructions, confirm your identity over the phone. And you would need to provide information such as your social insurance number, credit card number, things like that to confirm your identity. So make sure you're calling the right number if you are expected to provide information like that over the phone, and not calling some sort of scam number. So again, you would receive your credit report by email or by mail, which would have your credit score in it. I did include the numbers that were on the Financial Consumer website of Canada. You feel free to take a look and just make sure those numbers are also on the websites themselves for Equifax and TransUnion as things change. And so improving your credit score. So say your credit score is around 500. How do you get it back up? So the big things are always to make your payments on time, use your credit wisely. And so that means basically don't take on more credit than you can afford to. So you don't want to be going over your credit limit. You only want to use part of your card that you have available. And so to delve into the part of your card. So say if you have a credit limit of $1,000 on a credit card, if you're using $200 a month or like $300 a month, that's good because you're using a smaller percentage of your total credit score. You're not coming anywhere close to that $1,000 every month. But if you have a credit limit of $1,000 and you're consistently using $800, $900 a month, you're using almost all of your credit every month. And so the credit report companies are going to be looking at and saying that, well, hey, like you're very close to going over your credit limit every month. You're not as reliable of a consumer as someone who is only using 20, 30% of their credit each month. So that's what they mean by only using part of your credit. And then you also want to build a long credit history. So the longer you have a history of borrowing money and paying it back on time, which is the important thing, the better that, the more reliable you are seen as someone to lend money to. And so you want to keep older accounts open if there is no fee, just so that you can continue to say that, hey, I've had this account open for 5 years. I've never made a late payment. It can only help your credit score from there. Use them from time to time. And then don't make a lot of credit applications or credit checks. And so this is a big one. If you are shopping around and lots of different companies are running credit reports, every time a credit report is run, it dings your credit score a little bit. And so just be aware of how many times, how often you are having credit checks run on your score, because it's going to drop fast if it's very consistent. And so most of us, when we graduate from university, have some kind of debt, whatever that is. And so taking control of the debt is a really important part of managing your credit and debt. And so using savings to pay off balances where you can, pay down your highest interest debts first, switching to less expensive credit cards if there's fees associated with them for services you don't use. Say you don't rent cars or fly airplanes a lot, especially now during COVID. How many of you have travel credit cards that you use for the fees? If you're not using those benefits but paying that yearly fee, is it worth it, or is it worth it switching to a different card with a lower or no fee at all? And so if you need to decrease the amount of debt that you have, and you just can't pay it all back, calling creditors to negotiate lower interest rates or things like that is something you could always do. Start an automatic online bill payment to stay on schedule, and leave your credit card at home if you just can't control how much money that you're spending, or the desire to use some of that credit. And then avoid the buy now, pay later offers. So this is a common one. If you've ever been mattress shopping or furniture shopping, you may have been familiar with some of these. It's very common for furniture stores or other large purchases to have a no payments for 6 months, no payments for 72 months, and just have this deal. But then when those payments come due, if you haven't paid them, a lot of the time the fine print will be saying that, all right, well, you owe interest on this 6 months where you didn't make payments. it gets expensive really fast. And so it's always recommended when you see those offers, just don't go for it. And yeah, so when it comes to debt management options, there's a few different things. So this is when you're in a real rut, but there are services within Canada, credit counseling, which counselors can create a personal debt management program. Is based on consolidating a loan, which we'll talk about what that means. A consumer proposal is a voluntary offer that lenders through licensed insolvency trustee. Basically, it's a type of bankruptcy that's not full bankruptcy. And then there's full bankruptcy, which a trustee takes over your assets to cancel debts. So not that I would ever recommend, or I should say, never I would ever hope that you're in a situation where you have to use any of these services, but just so you know, it is there if it's at the end of your rope and you just need something to get your credit back into control and your debt back into control. And so making a plan to be debt free. So this is the last big thing that I'll be talking about today. And it's something that I'm sure most of you can relate to. When you graduate from Lakehead, most of us have debt. And so it's really important to hit the ground running so that you know what is the plan once you graduate and you get that first job. What are you going to do? And so there's a few different steps when it comes to making a plan to be debt free. You want to identify your debts, review your budget, decide on a strategy, consolidate your debts if you have a bunch from different areas. We'll go into more detail there. Avoid taking on more debt and know where to get help. And so let's go through all of these points. So once you graduate or once you're getting close to graduating, what do you want to be doing? First, identify where your debt is located. So make a list of everything that you have that is part of debts. And for each one, you want to be making sure you note how much do you owe in total, the minimum monthly payment, and the interest rate. And so examples of this would be if you are carrying credit card debt, would be a great example. If you are carrying student loans from OSAP or another province or something like that, another great one. Student line of credit, if any of you have those, that would be another one. If you have personal loans from a family or friend or something like that, you can add that there as well. And so the idea is to get a really good picture of what do you need to be paying back, and more importantly, how much a month are you paying back, so you can properly plan not only a budget, but as well as what do you need to be making per month in order to pay this back, and then come up with a good plan there. And then it's all about reviewing your budget. So the next step is to take a look at this. There's some great budgeting options that we had talked about at our first presentation in Financial Literacy Month. The Google Sheet template has a great budget template that you can use. Kind of already all the formulas are made. You just need to input the information. And then the Financial Consumer Agency of Canada has a budget template as well. If you go on their website, it's fantastic. That one is one I would highly recommend because all the categories are already made for you. And if you have any other questions, feel free to talk to us and we can provide you further resources. But that would be step 2. Step 3 is decide on a strategy. So there's 2 main strategies when it comes to paying back different debts. And some of them work great for some people, others work better for other people. So it depends on what strategy you would want to follow and what might work best for you. And so the first step would be to choose a time frame in terms of how long you want to pay your debt off. I would certainly encourage you, if you want to be aggressive, your younger years are certainly the way to do it. When you just move out from university, you still are used to living like a student. You may not have a family potentially. And so it's a great time to just be able to save a lot of money and quickly get rid of high interest debts. And then the next big step would be to decide which debts to pay off first. And so the two different strategies here are paying off the debts with high interest rates first, or paying off the debts with the lowest balance first. And so we'll talk about the first step here first. So paying off debts with high interest rates is going to save you the most money at the end of the day. You can easily order how many debts you have. Typically the credit cards, or if you ever took a payday loan, which I'm hoping you didn't, they're rather predatory, but I know they are something that is there, like Cash Money is the type of company I'm thinking of. And so those are typically the highest interest debts. And so by paying off those first, you're going to be saving money, and then work your way down all the way down to the lowest interest debts, which are typically like OSAP loans and things like that. They don't have that high of debts, but it all depends on the situation. Then the other way to do it is paying off debts with the lowest balance. So this one seems counterintuitive because you probably will potentially end up spending more money, but maybe not. So this one plays on the idea that there's a snowball effect, and that once you pay off one thing, oh boy, do you feel good, and you just want to get ready on the next debt and knock that out. And so it's more of a psychological trick, but it certainly does seem to be effective. And it's one that is recommended by a lot of different people, depending on how many debts you have, is to always start with those small balances, get those out of the way really quickly, and then work up to the larger balances once you have some motivation to tackle them. Because if your highest interest rate debt is not going to be paid off for 3 months, it can be hard to maintain that much motivation to pay it off every month or every time you get a paycheck. It seems like it's not going anywhere compared to if you focus on any small little debts, like maybe a credit card bill of you're carrying $500 worth of credit. You can knock that off in a matter of a few paychecks before you tackle some of those larger debts. And so that's where the paying off the lowest balance idea comes from. And then it is always encouraged once you're doing this, if you're having trouble, working directly with your creditors and your financial institution is always something that you can do. It is something where it doesn't hurt to just contact them and say and try and make a deal if you're having trouble paying off the debt that you took on. So trying to negotiate for a lower interest rate on your debt, or asking to extend your payments for a longer period of time and reduce your minimum monthly payment so that it's a little bit more manageable to start paying off your principal interest and not just the interest you're accumulating every month, but your principal is remaining the same. And I guess I should explain what principal means for those of you who aren't familiar with the term. When you take on debt through a credit card, for example, you buy $1,000 worth of stuff and you don't pay it back 1 month. So $1,000 is sitting on your credit card. That's your principal interest. Every month, that $1,000 is being charged interest. Say it's 20%, you're being charged $20 worth of interest every month. If you're just paying $20 back to your credit card every month, then you're really only paying the interest. You're not making any headway on the actual debt that's there. You're just kind of like maintaining. And so the idea is that you want to be paying more money so that you're eating into that principal amount, that $1,000, so that at some point you will be able to completely squash that and have no more debt. So that's the idea behind paying off your principal as well as the interest that you owe each month. And so things like this, by reaching out to your financial institutions, creditors, it definitely helps. If any of you have OSAP loans or provincial loans from Canada for students, then there are repayment assistance plans at NSLSC. If you went to the NSLSC presentation that we had this month, you would have learned more about that. But that would be another example of trying to work directly with a creditor, in this case, the National Student Loan Service Center. And so once you figure out what your plan is to pay this back, are you going to be paying off the lowest balance or the highest interest rate loans first? It sometimes helps to consolidate your debts. And so what this means is that you can take all of your different debts from, say, like 2 credit cards, and then say you have a line of credit somewhere else that's a little bit high, so you have a car loan, and you can consolidate it all into one payment. So instead of having 4 to 5 different payments you have to be keeping track of every month, you can consolidate the loan by going to a bank and saying, hey, can I get a line of credit with, say, a lower interest rate, or just something where it has one payment that you have to make. It's a lot easier to keep track of. Shop around, of course, and be vigilant when you're talking to different banks, figuring out what the best option is. But it's something that is certainly a good idea if you're having trouble keeping track of where all your debts are. Putting it all into one single loan can certainly make the task a little bit more manageable. And consolidating your debts means you only have to make one monthly payment rather than paying off a bunch of different debts individually, as I had mentioned. And so the next step, avoid taking on more debt. This one kind of speaks for itself. When you're trying to get out of debt, the last thing you want to be doing is adding more and more debt if you feel that it's not being used productively. And then the final thing I'll just mention is know where to get help. There are a lot of different services within Canada that you can go. If you're having trouble coming up with a plan or figuring out how am I going to get out of this, if that's the situation that you're in. So there's things like an accredited non-for-profit credit counselor, a financial advisor, a licensed insolvency trustee. And so those different resources are all across Canada. You can just look them up on Google and they'll provide you many different options. They may suggest to explore other community and professional services first. So depending on where you are, they might say, "I'll go here first, and then if it's still an issue, you can come to us." But just so you know, there is help available. You just need to ask for it. But those would be the things to look for. So thank you very much. I hope that was helpful. If you have any questions, Melanie and I are here to answer. And yeah, thank you for attending today. I'll leave it over to you, Melanie.